A very good evening to all the participants. It's my pleasure to be here speaking with you once again on the council meeting, which just recently concluded a couple of days back. And as you must have observed, we were able to share with you a brief advisory within an hour of the conclusion of the GST council meeting. And we felt that because there are certain far reaching changes, most of them being in the nature of beneficial rate amendments, we should have a quick type of a webinar, and therefore this session today, as usual, post any significant event on the GST front, we aim to reach out to our clients to explain the implications of that, and that's one of our initiative towards knowledge empowerment. To a large extent, on the 15th of August, when the Prime Minister gave his Independence Day speech, he referred to some impending changes. And of course, it was coined as GST 2.0, and therefore we are starting this entire slide with that word GST 2.0. Towards the end of the session, it will be for each of us to reflect whether this is GST 2.0, and I'll share those comments and reserve them towards the end. But what is important is the sense of urgency which came in because of the announcements made by the Prime Minister. At the time of Independence Day, he had said that there would be a sort of a Diwali gift, which would have tentatively been in the mid of October. We would have expected an effective implementation in the mid of October. Of course, we are aware that various committees constituted by the government and the GST Council worked the extra mile and were working upon the recommendations and finalizing the entire provisions. And thereafter, the GST Council was scheduled to meet for 2 consecutive days on the 3rd and the 4th of this month. On the 3rd of September, the meeting went into an overdrive, into a slightly longer meeting. And what we were seeing taken was for a pleasant surprise. All the states had a consensus, and instead of the 2 day meeting, they were able to conclude on the agenda on the first day. And late in the evening, around 9:15 or 9:30, the meeting concluded, and the Honorable Finance Minister then did a press briefing at a fairly late hour of the day. And there was clearly a sense of urgency, and that urgency also came up in terms of the identification of the effective date of the amendment, because the idea was to give the relief at the earliest possible time. The so-called Diwali was preponed to the first day of the Navratri season, which is going to be on 22nd of September. And therefore, the Honorable Finance Minister was also very categoric in saying that the rate changes, except one or two small changes, will come into place from the 22nd of September, which is the first day of Navratri. And therefore, I think there's clearly a sense of purpose when we look at some of the announcements which we are going to talk about in the session today. With that little bit of a background, let's look at what are the things which we are going to talk about. We'll first start with the key thing, which is the changes in the tax rate, what it means at a macro level. We'll go into the specifics of the products and the services slightly later. But before that, if your product rate or your service rate is changing, what it means for you is what we'll try to broadly look at the start at a conceptual level. We'll thereafter look at certain recommendations on substantive changes. Two major substantive changes are being proposed in the concept of intermediary service and in the concept of post-sale discounts. And both these changes would have very widespread ramifications. Of course, they won't be effective from 22nd of September, but we should understand the broad changes, what they are and how they are going to impact our businesses. So that is the second basket of discussions which we will do. The third are a few changes which are aimed towards achieving an ease of doing business. But as we will look into it, we'll understand that these are more smaller nuances which ideally should have been a expected type of a thing. But well, we need to keep on reiterating some of those things. So we'll talk about it. One significant change in the procedural basket is going to be the constitution of the GST appellate tribunal and the mandate to file all your pending appeals by the June of the next year, June 2026. So we'll touch upon that in a little bit more detail. We'll then go to the sectoral updates. We'll revisit the tax rates and see which all products the tax have changed and how does it impact the particular sector or the particular business. And finally, we'll just spend a few minutes on the way forward on the entire GST Council agenda. Coming to the rate structure, we are all aware about the current rate structure, subject to certain aberrations and specific situations like diamonds or gold, etc., which have very specific type of rate and that continue to be the way it is. The general slabs of taxes for the GST currently are five. We have a nil rate, which is the exempted goods and exempted services. We have three generic rates, 5, 12, and 18. 18 being the revenue neutral rate. Most of the products and services currently fall within that 18% basket. But then we have two concessional rates, 5 and 12. And we have one demerit rate, which is 28%. And many of the products in 28% today also bear what is known as a compensation cess. We are all aware of the history of the compensation cess, expected to be for 5 years, got extended slightly. And of course, now we are going to bring in a sort of a logical burial to that cess. So this is the current tax structure which has so many slabs. The proposal is to simplify this by reducing the number of slabs, because the multiplicity of tax rates always leads to a lot of interpretation issues. If you are paying 12, the officer wants to say it should be 18. If you are paying 18, officer might say that no, it should have been under 12 and you have wrongly claimed credits and things like that. So therefore, to avoid those types of litigation and ambiguity, and bring in a simplicity into the entire regime, and also to bring in certain tax concessions, we are now saying that we want to reduce the number of slabs. So the first area which we are attacking is the 12% tax rate. And make no mistake, the 12% tax rate is now abolished. So there will be no tax rate at 12%. So wherever as a particular business, if there are certain products or services which are at 12, please be aware that it will have either shifted to 5 or 18. Naturally, you are impacted. So it is totally abolished. Some of those items have gone into 18, but quite a few of those 12% items currently are moving into the 5% bracket. Again, interestingly, when 12% moves to 5%, in some cases we are told 5% will be with eligibility of input tax credit. But in some cases, the government has been slightly stingy, especially in case of
Yes,
certain
sir.
services which are moving from 12 to 5. They are saying that in those cases, I will move it from 12 to 5 with a condition that you will not be eligible for ITC. So within the 5% new proposed basket, there can be 5% normal or 5% without ITC, or it could be 18%. So that is how the 12% rate is sought to be abolished, and all those items will get consolidated into 5 and 18 in that manner. As far as 28 plus cess is concerned, the idea is to discontinue the cess. There's a statutory mandate towards it. So except tobacco products where because of the deficit in the compensation cess and the loan, we intend to continue compensation cess for tobacco products for some period. But subject to that, all other products, the cess is being discontinued, and to override the entire, the tax implications, we now have a new rate of 40%. So 28% plus cess is now merging into 40%. Again, there will be no 28% rate, like there will be no 12% rate. So the end result of all this reorganization or recalibration is that you will end up with two primary rates, 18% being the general rate, 5% being the concessional rate for certain products, a nil rate which is meant for giving exemption to products and services, and there will be a demerit rate of 40%, which will be for certain luxury cars and yachts and things like that. So this is how we are trying to bring in a simplicity onto the overall tax structure by reducing the complex five structure regime into perhaps a two major structure, and with an exception by way of exemption and a demerit. This is the broad philosophy of the entire amendment which is being proposed, and therefore you will see that when you look at the rate changes, and there is a detailed table, and that document is available with everyone today, you will see that there are so many items which are into the 12% or the 28%. They are now moving either into 5 or 18 or 40, depending on the specific use case or the rationale of that particular product or the service. Now, again, before we go into those specific items and sectoral impact, let us first understand that if some of your product or service rates are changing, how is it going to generally impact you? And I think the first thing which we already talked about is the fact that this rate changes will be effective from 22nd of September 2025. Unluckily, it's in the middle of a particular month, and therefore one will have to be very careful. Especially if it's a large organization, you will have to make sure that your systems changes are geared up to take a particular date, which is a mid period date. In case of services also, you'll have to be careful because many of the services are periodic services, and in that case you will have to be mindful of the transition impact, which we'll be discussing in the next slide. But yes, from 22nd September the rate changes will kick in into place. Notifications are still not out, but I'm not very doubtful about it. I'm sure with the elaborate the table which has been given in the press release itself, it wouldn't be a big task for the council to really come out with the notifications before the 22nd, or maybe at least by 20th they may be able to come out with the actual notifications giving the effect of these policy announcements. Interestingly, immediately in the press briefing, this question was coming up that when there is a rate change, especially when you are changing rates, you are reducing rates of parathas from 18 to nil, you are reducing so many food products from 12 or 18 to 5. What is the impact of the entire thing on the end consumer? Because the entire rate change is being positioned not only as a simplification and a calibration mechanism, but it is also positioned as a benefit to the end consumer. And therefore, the press were right in asking this question, that how will you ensure that the consumer effectively gets this benefit? When we are talking about this, we need to rewind our discussions, which we had a couple of years back, wherein we discussed that the anti-profiteering provisions under the GST law have already been given a go by. Only pending matters wherein the complaints have already been raised will continue with the GST appellate tribunal. Otherwise, no fresh complaints can be registered under the anti-profiteering provisions. They have already achieved their sunset clause. And therefore, this question from the press, and I think the revenue secretary was right in responding that yes, the anti-profiteering has seen its burial. He justified it by saying that there were only a few instances of complaints in the past regime of 5-7 years. And therefore, in his assessment, the industry is mature enough and they would pass on the benefits, and they assume that the industry and the businesses would pass on the benefit to the consumers. And honestly, I think that's the right approach, because end of the day, we are living in a free market. So maybe there might be short-term benefits or losses, but over a long-term period, the market dynamics, the consumer expectations will take place and will force the industry or businesses to temper around the prices. When we are talking about this is broadly at a micro level of consumers buying shampoos and toothpastes. But minding well that there are many business to business transactions. And in case of business to business transactions, especially if you are dealing with government contracts or you are dealing with a PSU, you might have entered into a long-term rate contract or maybe a long-term works contract. In those types of situations, there would always be, or in many cases, there would be a contractual clause dealing with a subsequent change in rate or a subsequent change in law. If there are clauses of those nature, you will have to be mindful about those clauses, and there might be an expectation from the client, especially government clients, that because of a change in the tax rate, please pass on the benefits to us. Of course, one will have to be mindful of the fact that a change in the input rate will not generally trigger a change in subsequent legislation or a change in the tax rate provision. It's only the change in the output tax rate which will impact. And this will be important because one of an important ingredient in the construction sector, we are aware, which is cement, has seen a rate reduction from 28 to 18. And therefore, with a little bit of a narrower mindset, many of the construction company clients might come back talking and invoking those clauses. Now, those clauses in most of those cases will not apply because the cement for a construction contractor is an input on which it is anyways claiming input credit. Today it is claiming paying 28 and claiming 28. Moving forward, it will be paying 18 and claiming 18. And therefore, honestly, there should not be an impact of subsequent change in rate clause in these situations. But based on past experience, I am aware that many of these companies will come back, and then this will have to be explained to those companies to say that this really was anyways a creditable tax. Being a creditable tax, there is really no effect. Of course, many a times because of the 28% tax rate on cement, many infrastructure companies faced accumulation, And to some extent, that accumulation issue will get resolved, especially if it's an SPV and there's an accumulation, there's a debate on what do you do with that accumulated credit towards the end. With that 28 going down to 18, at least that accumulation issue can be partially or to some extent reduced or resolved. Having said that, I am also aware that there are discussions at the cement manufacturer level to actually go ahead with a increase in the basic price because of cost inflations and other parameters. Now, naturally, if that is happening, maybe this a 10% tax reduction gets nullified by an increase in the base price. And if that happens, naturally, the contractors are worse off because of this change rather than being beneficial. Because today, if they are buying cement at 100 plus 28, they are getting 28 back. 100 is a cost. Moving forward, if it aligns to 100 plus 18, there's no issue. It's still 100 as a cost, no benefit, no loss to the contractor. But if it changes to 110 plus 18, then there is a problem because the contractor effectively ends up losing in those types of situations. Again, these are market dynamics, and one will have to see how this spans out as time progresses. That takes me to two other aspects which we need to look at. One is a very specific impact, which is a transition impact, especially in situations where there are certain advances received before the 22nd and the balance payments are received thereafter, or where the goods are supplied but the payments are not received or the goods are in transit. Those types of situations we'll have to look at. And finally, we'll have to look at the impact of this tax rate change on the ITC reversal, especially if the tax rate change is from some rate to nil or some rate to a 5% without ITC. And there are examples like that. For example, if you look at hotel accommodation, today they are paying 12% with input tax credit, but now we are told that if the value is less than 7,500, you will end up with 5% without input tax credit. So while there is a reduction in the tax rate from 12 to 5%, it comes with a consequential impact of no input tax credit. And then when we say no input tax credit, it does not mean only one-to-one identified input tax credit which is lost. We are all aware about a draconian and a complex provision of Rule 42, which says that if there are common credits, those common credits have to be proportionally reversed. And therefore, there will be some impact on that front, which also we will need to examine. So let's go into understanding firstly the transition impact, and then we'll look at the reversal impact. As far as transition impact is concerned, the first area which we'll have to discuss is about the services in transition. And as we are aware, Section 14 actually envisages a situation of a change in the tax rate. And it says that if there is a change in the tax rate, which will be the effective tax rate applicable to a transaction, will be determined based on 2 out of 3 criteria. And they've said, what are those 3 criteria? One is the payment, one is the raising of the invoice, and one is completion of service. So give you an example, if there is a medical insurance which has been taken by an individual, and we are aware that as of now, the medical insurance is liable for 18% GST, but we are told that it will now move to an exemption zone. So from 22nd of September, there is no GST on medical insurance taken. Now, typically you would have taken a policy, let us say in the month of June, and that mediclaim policy, you'll have paid a premium for the entire year from June to May. And if that be the case, you might be interested in seeing how I can enjoy the benefit of this exemption. And the answer to that will lie in Section 14. And what Section 14 would say is the insurance company will have to see these 3 criteria. Has it received, when did he receive the payment? It received it in June. It raised the premium receipt or the invoice in June, and the risk commenced in June, though it is concluding in May of the next year. So at least 2 out of those 3 criteria clearly are in the older period. And if they are in the older period, in that case, the old rate will apply of 18% and not the new rate of 0%. So that is how one will have to look at the entire service transition scenario and accordingly determine the tax implications. Now, compared to that, when we look at goods, the situation in goods is slightly simpler because the expectation of the government is that the moment you remove the goods from your factory, you are required to raise an invoice and you have to pay the tax at that point of time. Luckily, there's an exemption which says that you don't need to pay tax on goods at the time of receipt of advances. And therefore, the The point of taxation in goods is slightly simpler. The moment the goods are removed, you pay the tax. If the goods are removed before 21st or 22nd of September, that is by the 21st of September, you will pay the old tax rate. If you are removing on 22nd or 23rd, then you will pay the new tax rate. But in goods, the situation becomes not complex because of the continuity of the transaction, but because of the continuity of the goods in the supply chain. And as we are aware, a manufacturer will sell goods to a distributor who in turn will sell to a dealer, finally reaching the end consumer. And therefore, there will be goods which in the industry is known as secondary goods, secondary inventory, which lies not with the manufacturer. He has already sold the goods to the distributor, dealer, etc. But the goods have still not reached the end consumer, and therefore they are in the supply or distribution chain. In this situation, we'll have to look at two, three scenarios. A scenario where there is a mere rate change. For example, if you look at namkeens, the rate has changed from 12% to 5%. Now, in this situation, if the manufacturer has already cleared the namkeens on payment of 12% and the distributor has claimed the credit, there is the end of the game. When the distributor further sells this stock, he will continue to pay 5%. Now, look at the distributor end. He has an input invoice of 12% and output tax of 5%. The advisory rightly and clearly says that you will continue to claim that input of 12 because your goods are lying in stock and you will now be selling at 5 does not mean that you will only get 5. You will continue to get that 12 rupees as credit. That is not impacted. You can adjust it against this 5. There will be surplus. You can adjust it against some other taxes which you have to pay. There's no problem. Now the question is, what if I am not able to adjust and there is an accumulation? And therefore, a question which was asked in the FAQ was, if because of this 12 to 5 transition, if my purchases are at 12 and my sale because of the change in the tax rate happens at 5, whether I can claim a refund under section 54 due to inverted duty structure. And the FAQ 10 clearly says that no, this is not a change in the tax rate, change in the input output, it's only a change in the tax rate, and therefore you cannot claim the refund under the inverted duty structure. So therefore, in those cases, there can be a little bit of a timing issue or a cash flow issue, working capital issue at a distributor dealer level, but at some point of time, I think this will get resolved. The larger challenge which we see specifically is in two sectors. One sector which we clearly see a challenge is the auto sector, because in the auto sector, what we are doing is we are actually doing away with the compensation cess. So the today's tax structure is 28 plus cess, ranging from different levels, many a times at around 12 to 13%. So that 28 plus 12 is now moving to 40 or 18, depending on the situation. The problem which arises is compensation cess is ring fenced in terms of credit. Credits are available for compensation cess, but they are ring fenced, meaning you cannot adjust a compensation cess against the tax output tax liability. It will be adjusted only against cess liability. But moving forward, the distributors and dealers are not going to have any cess liability because the cess is now submerged into the basic tax rate of 40% or 18% as the case may be. And therefore, distributors dealers may end up, as in the auto sector, we may end up with an accumulated compensation cess which they are unable to utilize or which they are unable to take it into their tax returns. As of today, honestly, the law does not provide any clarity or no guidance has been provided. We are aware that this can become a major stumbling block or a working capital blockage, effectively at some point of time even resulting in a loss, because end of the day, if there is no reinstatement of compensation cess, there's no way you can adjust it. So unless the industry represents and some sensitization comes from the government and they bring in some express provision for this issue of accumulation of compensation cess, you might end up with an outright loss of that compensation cess. Now, naturally, that's not what is intended, because the idea is clearly to give the benefit to the end consumers. And if that be the case, naturally, the dealers and distributors will question that how do we ensure that this does not become a loss. And I think the answers are not easy. As I said, if the government brings about some major change, it's a different scenario. But more likely than not, they may not do so. And if that be the case, we may need to factor in, dealers and distributors may need to factor in this type of a cost. It may make sense to engage with your manufacturer and examine a possibility of returning the stocks as on 21st of September and freshly procuring the stocks on 22nd September. Of course, what it would therefore mean is that the issue would now go from the distributor dealer level back to the manufacturer level. Because of the goods rejection and the credit notes, the compensation cess accumulation at the distributor level will flow back by way of a negative output tax and a credit note adjustment at a manufacturer level. Please note that after 22nd September, even a manufacturer does not have any output compensation cess to pay. So we are actually moving the problem from the distributor to the manufacturer level. But a fundamental difference between a manufacturer and a distributor is that at the manufacturer level, the amount which has been accumulated is not on account of input credit, but is on account of excess payment of an output compensation cess. And therefore, at the manufacturer level, the manufacturer can invoke the provisions of Section 54 and say that because my original supply did not get consummated, the original tax paid by me, the cess paid by me is in error, excess tax paid in error, and he can file a refund application. There may be a ground level litigation, but the provisions in the law clearly permit a refund of taxes, including cesses, in case a transaction is not consummated. So I think that is the way in which this compensation cess can be safeguarded. There will have to be an active dialogue and alignment between the distributor dealers and the manufacturer. This may mean some transaction costs. This may mean in terms of reverse logistics and all, but I think that is a safer and a more certain type of a solution to this problem, especially if the amounts are large. There is also a thought process that can I somewhere apply for a refund of this accumulated compensation cess? We need to be wary of the fact that there is no specific provision under the law which permits a refund in these types of situations. One may want or be tempted to apply a recent decision of the Sikkim High Court in case of Sikpa, which said that on closure of business, if there's a closing balance, you'll get a refund back. But be mindful, the distributor dealer has not closed his business. The business is continuing, and therefore it's going to be a long haul battle for a distributor or a dealer to file a refund application. It may be more appropriate that there is an alignment and a discussion with the manufacturer, and the onus of claiming a refund is passed on to the manufacturer by way of goods rejection rather than trying to take an adventurous view in the case of a distributor or a dealer. That takes me to the second basket of discussion on the tax rate changes, which is relating to the ITC reversal impact. Now, this, of course, will not apply in general in all cases. It will apply only in situations where your tax rate is either reduced to nil, the product is moving from a taxable zone to exempted, or the movement is to a lower rate of 5% with a condition of no corresponding ITC. In these situations, clearly, you can't claim the corresponding input tax credit. For the goods which are lying in stock, you will have to reverse the input tax credit if you have already taken. Also, for the common credits, there will be a Rule 42 reversal because moving forward, post 22nd September, the value of these supplies will be treated as exempted supplies, impacting your ratio. Ratio will become adverse, and therefore each month from September onwards, the ratio of provisional reversal will be higher and you will reverse higher amount. And in the month of March, when you are doing a true up for the entire financial year 25-26, again that ratio will also go on a higher side and will require a reversal. Now, and especially when you are looking at the hospitality sector, hotels especially will have a major impact because of this. As of today, you will see a reversal of the common credits, and that is not going to be big because that's whatever is the common credit for the month, that we will be applying a ratio. But when it comes to March, please understand that the final reversal which you will be doing in the March will be for the entire financial year. Therefore, whatever credits you have already claimed from April to August will also get impacted because of the so-called exempted supplies made from September onwards till March. So therefore, there will be a sort of a little bit of a retrospective impact of this at the time of final reversal, which we may need to bear in mind. From tax rate changes, let's move to some substantive changes. We'll come back to tax rates in with the specifics, sector-wise specific rates after a couple of slides. But before that, let's look at some major substantive changes. And both these changes are not coming by way of an amendment in the law. These are mentioned in the press release, and we need to be sensitized that both these amendments will require amendments in the act itself. There is no draft amendment in the act which has been given to us. It will take some time for the council to really draft it, and after that it will have to be passed in the parliament and all the states, and therefore definitely these two changes are not going to get effective from 22nd September. It will take some time to come into place, and we'll have to wait and constantly monitor the effective date, which will be a date to be notified after the law is enacted in this regard. But both of them are interesting amendments and far-reaching amendments. So we need to discuss this. We'll again revisit this as and when the actual effective dates are notified. But today we should take this opportunity to really understand these changes. And the first one is a reconciliation to something which the Supreme Court has ultimately held, which is relating to this concept of intermediary. And this concept of intermediary has kept on bothering these businesses for a fairly long time. We are aware that this is an issue which started in service tax in 2014. Of course, prior to that also, many commission agents were facing difficulty in claiming the benefit of exports. They used to receive commission from foreign companies, foreign universities, foreign manufacturers, and department was saying, no, this is not exports, because what you are getting is for marketing a product or a service of a foreigner to an Indian end consumer or an Indian buyer. And therefore, the delivery or use of services in India was the first argument which the department used to take. Thereafter, they brought in a clause called intermediary, and they defined the place of provision of service to be the location of the supplier, and that continued in the GST regime as well. Recently, the Supreme Court had occasion to discuss this issue in two cases. One is the Vodafone case, which went on discussing and bringing a finality to this issue right from 2005 all the way to 2014. Of course, it came in 24, but 25, but that's a secondary part. But it brought a good amount of clarity. It said that in all these situations, if I am contractually dealing with a foreign customer, the transaction should be treated as an export of services. And therefore, many of the old service tax matters get a resolution because of that Vodafone decision. But the GST law continued to have this intermediary provision. And therefore, we found that there were many situations where under GST, because of the intermediary provision, the benefit was not being granted, and the provisions were also very clear in this regard, subject to a little bit of an interpretation issue. And this was adding to a lot of cost for these types of intermediaries. It was not only those commission agents who were facing the problem. What was happening was the interpretation of this word intermediary was very subjective, and many revenue officers used to even consider principal to principal transactions as amounting to intermediaries. We saw a lot of litigation both in the freight forwarding sector, in the IT sector, wherein an IT company would undertake projects on behalf of a client, and naturally, while doing that project, he will interact with the client's client. The moment the department sees three people involved in a transaction, they would want to say that this is intermediary and immediately deny the export benefit. So there have been a lot of litigation on that front at the IT sector. Same thing with a freight forwarder who would buy freight from a shipping line and sell it to an end customer. So the department would always say that, look, there are three people, and that they were many a times not ready or not able to understand the distinction between freight trading and a freight agent. And all of this was resulting in disputes, matters were going in the courts and all those things. Now, what is being proposed is we are deleting these provisions relating to intermediary. And therefore, with the deletion of this provision, I think both this basket of situations, the actual intermediaries like the commission agents and the university agents, as well as the so-called interpretation issue in case of IT services, freight forwarding, etc. All of those disputes will ultimately go away, and the export benefits will be reinstated to all the so-called intermediaries or interpreted intermediaries. Therefore, in that sense, it's a very welcome change. It's come late, but better late than never. So I think in a way, it's a one should appreciate the efforts taken by the government in trying to delete this entire provision. So that is the first thing. I'll conclude on this point with a caveat to say that this is not immediately effective. It will take some time to get effective. Similarly, the second issue which was brewing and which continues to present sleepless night is a case of discounts and promotional schemes. There was one circular, the circular was sought to be amended, but that circular created more difficulty, so that second circular was later withdrawn. And now the thought process is, let us now again go back and discuss a few of these issues. So, as we are aware today, Section 15 permits a deduction of a pre-supply discount from the value of taxable services. We are now saying that we will not any longer distinguish between a pre-supply or a post-supply discount. Both pre-supply as well as post-supply discounts will be eligible for reduction in value. And in that sense, the requirement to go back to a pre-existing scheme or a agreement, all those requirements are sought to be done away with, because that was where there was a lot of litigation, interpretation of the schemes, because most of the times the agreement will not foresee the types of the discounts which are likely to be given on a day-to-day transactional level. So the requirement of a linkage of a discount with an agreement, pre-existing agreement, and therefore qualifying as a pre-supply discount itself is being done away with, is proposed to be done away with. Second situation, which of course was already delinked, but they are reiterating it for whatever reasons best known to them, is the fact that credit notes need not be linked with invoices. Because many a times the department used to insist that, okay, you are giving a credit note, please link it with a specific invoice. So now we are explicitly told that the credit notes need not be linked with invoices. Last budget, we had a discussion about a circular which proposed a requirement of a CA certificate, that if the supplier is claiming an output tax reduction because of a credit note, the recipient should give a certificate by himself or a CA, depending on the amount, that he has reversed the ITC. Now, because IMS is being implemented and credit notes have to be mandatorily accepted or rejected, therefore, they have now done away with that requirement. The circular is proposed to be rescinded. So, in that sense, again, a lot of operational convenience comes in because of that. Of course, the concept of financial credit note will continue, but over a period of time, there have been lots of debates that if a supplier issues a financial credit note, whether the recipient is liable for to reverse the ITC. So it is proposed that they'll clarify that there is no requirement of reversal of ITC at the recipient level. The supplier can issue a financial credit note and the recipient can claim ITC of the full value, and he did not proportionately reverse the ITC. There is also a little bit of an open-ended clarification, and we'll have to read the detailed clarification when it comes out, wherein they are going to talk about treatment of post-sale discount given by a manufacturer for some transaction between a dealer and an end customer. So typically the price protection discounts which are being given, they are going to clarify something about it. Since the clarification in detail is not out, I would restrict myself from going into forejudging what they are wanting to clarify. We'll have to see the clarification as and when it comes, but this is an indication that something is going to come on this front. Similarly, many a times dealers are expected to undertake certain promotional activities like field awareness or sponsorships, etc. And the costs are reimbursed by way of a credit note or by way of a discount. And how should that be treated? That also is something which is going to be clarified. So we'll wait for those clarifications. But again, this is one space which seems exciting, and we'll have to keep on watching what's happening on that front. That brings me to ease of doing businesses. Now, somewhere certain things which are, sort of a day-to-day right, or something which would have been done on day one, we keep on saying a little bit about it and keep on talking about it every time. So these are some provisions like that. We may not read too much into it. Firstly, we are told that on making an application, a provisional refund of 90% will be given to exporters, SEZ units, and in case of inverted duty structure refunds. I believe that these provisions are existing even to today to a large extent. Of course, low value consignment exports where refund amount is less than 1,000 is today not permitted. They are now going to enable those low value consignment export refunds. I don't think this is a significant going to significantly impact. Of course, some small players might get a small benefit, but I don't think it's something which is really going to be we should be spending too much time on. There's a simplified registration scheme for small businesses which are primarily acting into B2C space and having a very limited turnover in B2B activity. In those cases, there is a promise of giving a registration in 3 days. Similarly, for such businesses, if they are supplying goods through e-commerce operator, today, as you are aware that in such cases, they need to obtain registration in each of the states. So that is something which they are trying to simplify. We'll have to again see what are the specific amendments in this regard and to what sector of the population is this going to impact. But these are some small steps which the government is talking about in terms of ease of doing business. Towards the end, when we discuss the way forward, we'll again circle back on the ease of doing business and we'll really try to ask some pertinent questions in that regard. But before we go on to the sectoral impact, a last slide which we are going to talk about is something which has been, expected from day one, from 2017, but ultimately in 2025, we are seeing the light at the end of the tunnel. The GST appellate tribunal, we are aware of the litigation process that once a show cause notice is confirmed, you are required to pay a pre-deposit of 10% for a first appellate authority or appeal before a first appellate authority. And if the first appellate authority order is against you, you have to file an appeal in the tribunal, which requires a further pre-deposit of 10%. So you have paid 20%, but you are unable to file an appeal. We are all aware that today the GST 80 is not functional, so you are unable to file an appeal. And right from 2017-18 till date, all the pending matters are lying in pipeline and they have not been. And on all these cases, 20% pre-deposit is stuck with the government because there is no mechanism of a disposal of the appeal. Having said that, what we are now told is yes, the president is in place, the lot of members have been appointed, the benches have been identified, and a lot of progress is there. The system is up and running as of now. And therefore, we are told that by the end of September, the system will start accepting the appeals online. So, for all the pending appeals, we can start filing appeals maybe by the first week of October or so. And we are told that for all the pending matters, the appeals should be filed by an outer deadline of 30th of June 2026. So we have around 6-7 months of time within which we would be required to file all the pending appeals, which means that we will have to undertake a comprehensive review of all situations where the orders have been passed by the first appellate authority and we intend to go in a appeal before the GST appellate tribunal. Bear in mind that the role of the GST appellate tribunal is threefold. One is the original side, where it will take up and entertain appeals against orders of the first appellate authority. It also will undertake discussions and decisions on the pending cases of anti-profiteering. Two orders have already been passed by the principal bench in this regard, and therefore, to that extent of anti-profiteering, at least the bench is already functional. And it will also act as a national appellate authority in case of conflicting appellate advance ruling authorities orders. So there's a consolidated role at the GSTAT level, and we'll have to really see it's going to be the next phase of how the entire structure of the GST will be implemented on a long-term basis. So we'll just have to wait, keep our fingers crossed, and just watch this space very closely. With that, we now go to the last part of discussion, which is about the micro rate changes which have come up at a sectoral level. And these are all going to be, from one percentage to another percentage. And as we said, all of this will be based on the broad principles which we discussed earlier. And in that sense, I think a couple of sectors which are clearly impacted by this is the first sector being the automobile sector. And this has been talked about a lot in terms of the substantial relief being granted. In fact, to a large extent, post Independence Day, we have seen that the end consumers, including you and me at times, have deferred our decisions to buy a car because it's a large capital value item. And somewhere there was a lot of noise to say that the rates are reducing. And if the rates are reducing, I might as well wait for a couple of months rather than pay that extra 10%. So in that sense, what is changing? We are told that the 28% basket is moving either to 18 or 40. Most of the small cars, and they've defined small cars in a particular way, motorcycles, buses, trucks, ambulances, three-wheelers, all of that moves from 28 to 18. The larger cars, what we call luxury cars, which are defined to be exceeding 1500 cc or 4000 length, and utility vehicles, etc. Certain specific type of luxury cars move from 28 to 40. Of course, currently also these vehicles typically attract a cess, and therefore it's not really an increase from 28 to 40. The cess gets consolidated into that 40% as we discussed earlier. There is also a 40% tax rate applicable on personal use aircraft and yachts. And therefore, those types of products which are seen goods will attract the 40% rate. A major type of a consolidation comes in identifying that all auto parts, we will take it to a consolidated tax rate of 18%. And in the past, we have had lots of disputes. Supreme Court also, there were conflicting decisions on classification of auto parts. There were many circulars issued in this regard. Whether you are going to put an auto part as a categorization of an automobile parts, or will it go into the specific basic product, something like a nuts and bolts? Nuts and bolts are generally covered as iron articles under chapter 73. So are you going to put it under 73 and therefore apply the tax rate of iron articles, iron and steel articles? Or will you apply the auto parts rate, which might be 28% or 28 plus cess? That has always been a controversy because the chapter notes under the customs classification define this classification based on general rules of interpretation, which include various section notes and chapter notes and the interplay of all of this, which resulted in lots of complications on this front. And everyone was on the edge of how do I deal with this issue. And I think that's where there is a comprehensiveness which we are trying to bring in. We are saying we don't want to go into all of those things. All auto parts, irrespective of whether you are going to classify under chapter 73 or 84 or 87. As far as GST is concerned, all of that may be relevant for customs, but for GST, we are going to always say that all auto parts will be 18%. So I think that's bringing a lot of reduction in litigation moving forward. This was something which was always a discussion right from day one, and this was being anchored around and talked about a lot. The benefits for the common man, the consumer items, and the idea is really to reduce the tax rates for them. So, in this situation, today there are a few FMCG products, electronics like air conditioners, dishwashers, certain larger TVs, larger computer monitors, which are all attracting 28%. They are moving from 28 to 18. Many items of day-to-day consumption are moving either from 12 or 18 to 5. Simple things like hair oil, toilet soaps, shampoos, toothbrush, pastes, footwear, paintings, toys, talcum powder, cutlery, utensils. Many of those things are moving from 12 or 18% to 5%. And therefore, one might be tempted to say that this will result in a reduction in the monthly expenditure or the monthly outflow of the common man. We were just discussing this internally, and the thought process was where does the government get the revenue for? Because if for so many items we are reducing the tax rates, what is the impact? And this was what was being asked to the revenue secretary. And the revenue secretary was slightly guarded in the press conference. He did say that perhaps there might be an impact of 48,000 crores, but we are not assuming that to be a revenue loss or a fiscal loss, for a simple reason that we are expecting a buoyancy. I'm not sure whether somebody starts consuming more toothpastes because the rate is lower. That ideally doesn't happen. But I think what the revenue secretary is also hinting at is a better compliance. In some of these products, there is always an inclination to buy products without a bill, especially if they are high value products. And therefore there is always a delta of a effective price payable when you buy a product between buying against a bill or buying without a bill. Now, When you have a higher tax rate, this delta is high, and therefore, at both the ends, the suppliers end, the retail stores end, as well as at the consumer end, there is always an inclination to save or avoid that tax. Now, with the delta going down to 5%, many a times the consumer might be willing, because the delta is so low, small, the supplier might be willing to pay that 5%, or the consumer might be insisting on an invoice for documentation and many other purposes. And therefore, perhaps what happens is a lower and an affordable tax rate may not increase consumption, but will definitely increase the compliance. And when the compliance increases, it comes up as higher consumption, because whatever is the compliance is the only thing which the government knows. If there's no compliance, the government doesn't know that the transaction actually happened or did not happen. And perhaps that's the reason why we are reducing the tax rate from 18 to 5 for simple things like haircuts, barbers. I mean, just think through it. When was the last time you insisted for an invoice from your barber? So now, if the tax rate is reducing from 18 to 5, naturally all these beauty treatment services, health clubs, yogas, fitness centers, beauty salons, all of that, perhaps there would be a better nudge to increase the compliance. I think that is the thought process, though not said it in so many words. Somewhere the revenue secretary did hint at compliance increasing, but this is what I think is the thought process. That takes us to the next sector, which is the infrastructure sector. And I think the big ticket item here clearly is the fact that the cement is going down from 28 to 18. We already discussed a bit about it. There is also that marble blocks and sand lime bricks, etc., which is going down from 12 to 5. Again, this can have a little bit of an impact. Maybe from a real estate sector, it will impact a bit because they are not creditable businesses. But from an infrastructure sector, all of these were anyways creditable. But yes, this is the change in the tax rate which is happening. On the output side, be wary that that 12% tax rate has gone, and therefore various concessional tax rates given to the ONGC projects, oil and gas exploration projects, earthwork related works contracts, etc., all of that move from 12 to 18. So that is one important change which we need to keep in mind. The subcontractors in this sector were also given the concessional 12% earlier. Even those subcontractors will move from 12 to 18. So that is a change which one needs to bear in mind. That takes me to the hotels and restaurants and F&B. I have tried to club three sectors for ease of understanding and discussion. I think a few changes. The first is only a clarification. We always believed so that when in the last amendment they had said that a star rated restaurant can opt for 18 with ITC or 5 without ITC. There was a debate or some interpretation some people were taking to say standalone restaurants can also choose 18 with ITC. And I think that's what they've clarified, that no, standalone restaurants do not have an option to claim 18 with ITC. They continue to be always under 5 without ITC. So I think that is reasonably clear, and I think it was clear, but they've still re-clarified that aspect. The change is relating to hotels. And as you are aware today, there are two rates: less than or equal to 7,500 is 12%, above 7,500 is 18%. And now we are told that for those lower value hotel room rates, you will end up with 5% tax instead of 12. So there's a straight away reduction of 7% of tax, but that comes with a condition that you are not eligible for input tax credit. And therefore, here hotels will have to be very careful that this will result in a reversal of input tax credit, which we discussed a few minutes back. We are all aware that for hotel accommodation, earlier the discussion or the cutoff of the rate was based on the declared tariff. But since a few years, we have done away with the declared tariff. So it's the transactional rate which will be taken into account to determine whether it is less than equal to 7.5 or more than 7.5. So that is also one factor which we have to be aware about. Coming to the products being sold as a goods and not as services in restaurants or hotels, we see that there are substantial reliefs being provided. So many products moving from 5 or 18 or 12 to nil, or from 12 to 5 or 18 to 5, and things like that. So you'll see that the entire food sector, which is basically HSN 2106, is moving from 12 to 5. Let it be something like a butter, ghee, chocolates, ice creams, milk drinks, sugar, fruit juices, or namkeens, coffee. Of course, all Indian breads are moving to nil, and that was specifically discussed by the finance minister as well. Milk is moving to nil, UST milk, paneer moving to nil. Certain kinds of sugar, cocoa, pastries, and cakes, biscuits, etc., are moving to 5. So, in that sense, while restaurants, hotels directly have no major impact, all of these are inputs for them also, and therefore that will impact them to that extent. Of course, when you are looking at non-alcoholic beverages, today they are at either 18 or 28. Many of them also bear a cess. Now that is getting consolidated into a 40% tax rate. So that is how the rate changes in the hospitality sector are impacted. That takes me to the health sector, and this is a big ticket item for you and me as an end consumer. We are told that all individual life insurance and health insurance policies will be exempted, and reinsurance of such insurance policies will also be exempted. So the next time you renew your policy, you will find that it will be at a slightly lower cost. Many of us might be working in corporates, and the companies are giving group mediclaim policies and paying the mediclaim premium on our behalf. It may be considered as a part of CTC or not, that's another aspect. But we do have that situation where there are group mediclaim policies. The emphasis in the notification is very clear, in the press release is very clear. They're talking about individual policies. Group mediclaim policies, I would believe, are distinct from individual policies, and therefore, for the company, when it goes ahead to renew the group policy, according to me, this exemption will not apply. But we'll have to just see how things proceed on this front. Since ITC is also not available to the company, it really presents a situation of a disparity between an individualized insurance and a group insurance through a corporate plan. So when we'll have to really see how this pans out, whether there's some clarification or a suitable amendment in this regard, because clearly it becomes a bit discriminatory. For the health sector, also from the perspective of the purchase of medicines and instruments, there is a lot of change. Most of the products which are today at 5 or 12% or 18% are moving to either 5. Most of them are moving to 5. And a few life-saving drugs and medicines are moving to nil, especially when they are used for treatment of cancer or rare diseases, then they are moving to nil. Otherwise, most of the other medicines and drugs, including devices, are moving to 5%. So that's a substantial impact which will come in the case of the health sector. Transport and logistics, the whole objective is to do away with the 12% rate. So wherever there were those options of 12%, they are getting transitioned to 18%. So for example, as a GTA, you had a choice of 5% RCM or 12% forward charge with ITC. Now, because 12% slab itself is moving away, you are moving this to 18% with ITC. Same way, rail multimodal pipeline transport had a rate of 12%. It is moving to a choice of either 5 without ITC or 18 with ITC. Rent a cab, where there was a 12% with ITC on forward charge, moves to 5 without ITC or 18 with ITC. Please note, 5 without ITC still permits a credit of a subcontracted rent-a-cab operator. So in this sense, these are small minor changes just to accommodate the fact that we are actually doing away with the 12% tax rate. But I think the larger impact here is the deletion of the intermediary service, which we discussed. We are all aware that the entire freight sector, the freight forwarding sector, has as of today so much of pending litigation. Not that that pending litigation will go away, you will still have to win those battles which you will ultimately win, but at least future battles will not initiate, because a year back they had clarified that freight is recipient basket. Now with the intermediary getting deleted, there's hardly any scope for the department to deny you export benefits for invoices raised to foreign customers. That takes me to the last slide on the rate changes. And again, of course, there's a long laundry list running into around 100 pages, and we cannot go into those sector specific and HSN specific rates, but we are looking only at the key rates. And I think the key change here again is a reduction in the rate of renewable energy devices and plants like solar plants, etc., where again the goods and services, the tax rate is reduced from 12 to 5%. Again, textile sector, most products move from 12 to 5, except few ready-made articles exceeding 2,500 per piece. Luxury ready-made articles is what they would believe it to be, where it is moving from 12 to 18. Again, many job work services were under the 12% basket. They are realigning to 5%. And finally, for the gaming and gambling activities and lotteries, today the rate is 28%. Because 28 is vanishing, it will move to 40%. So I think these are some of the tax rate changes which come in. And finally, before we conclude, maybe a couple of minutes on reflection of these changes. As we can see, a lot of it is in a way a consolidation. Whether it is really GST 2.0 is a question which we need to ask. And I think to answer that question, we need to understand the impact, which in Revenue Secretary's term is a fiscal deficit of 48,000 crores, which also was guarded by saying that to a large extent it will get covered up by buoyancy, compliance, etc. etc. Is it really compliance or buoyancy, or is it something else? And I think to answer that question, most of us here are tax managers at our organizations, and we know the day-to-day rigmarole which comes along with compliances. 48,000 crores of a revenue loss perhaps can get eradicated just by one show cause notice to Infosys of 32,000 crores. And we are all aware of the circular of the CBEC, and despite that circular, a show cause notice being issued to Infosys in starking contrast to the circular of the CBEC. And therefore, when we talk about GST 2.0, it's not just about making a rate change. It is important to change rates. It's important to change the law to avoid controversies. But at some point of time, the government needs to introspect why many of these controversies happen in the first space, despite the law being clear itself. This type of a convoluted interpretation of the law or non-obedience of the law by the revenue implementing officers is something which needs to be reflected. The moment that approach changes, I'm sure all of you will agree, that is when we will really reach GST 2.0. Till that time, I would believe that it may not be correct to classify this as GST 2.0. At the most, one might say it is GST 1.5 rather than 2.0. The real 2.0 will come when you are not asked questions for from five authorities for the same reconciliation in five different methods. So I think that was from my side. We will now spend a few minutes taking up questions. I think I already have a couple of questions. I'll read them out and maybe we'll try to take them up. And if somebody else has the questions, they can unmute or they can put it in the chat box also, or preferably if they can unmute and ask themselves, that would be useful. I think Purnima has a question. Group insurance policies do not appear to be covered under this exemption. Yes, Purnima, we discussed that it does not get covered. It may be unintended, but yeah, that's more like a policy decision. Unless they change it, there's going to be a problem. There's a Gauri D'Souza asking whether GST gold rate is still under the slab of 3%. So again, it should be considered as a luxury product. Then gold rate will not inflate. What are your inputs on this? Uh, I would believe that the gold rate, the rate is not changing definitely. I think Gauri is proposing that the rate should be higher being a luxury product. We need to bear in mind that gold is not only a consumption item, it's also an investment item. And that's the reason why it has a lower rate. So I think that's what that means. Uh, if there's any question somebody wants to ask, they can put it on the chat bot or they can unmute themselves and ask. Okay. Thank you very much for coming online and spending your time today. Thank you. If there are any questions, we will take it up.